Directors and dividends, the 39.35% tax reality. If you're a company director retaining six-figure profits each year, this matters because many directors never calculate what it truly costs to move money from company profit into their personal account. Once you layer corporation tax and dividend tax together, the combined cost can approach 40 pence in the pound. Over a decade, that silent friction can create a substantial gap between what your business earns and what your family ultimately keeps. So let me show you how that actually happens. Well, firstly, there's a difference between compliance and strategy. Compliance looks backwards, filing returns correctly, but strategy looks forwards, structuring capital efficiently between your company and your personal balance sheet. Traditional low salary, high dividend model is often presented as standard practice, but for high earning directors, it isn't always neutral. This is an early, simple example. Let's take a simplified illustration. Your company earns £100 in profit. At the main corporation tax rate of 25%, £25 is paid in corporation tax. That leaves £75. If that £75 is then paid as dividends and falls into the additional rate tax band, dividend tax of 39.35% may apply. After dividend tax, what actually lands in your personal account is materially lower than the original £100 your company generated. Now, individually, each tax is straightforward, but layered together, the effective cost of extracting that money becomes significant. This isn't about avoiding tax, it's about understanding the structure before decisions are made. Now, here's what's interesting. Most directors don't end up here because they've made reckless decisions. They end up here because dividends feel familiar. It's what they've always done. It's what gets discussed first. That familiarity bias at work. Familiar feels safe. But over time, familiar doesn't always mean efficient. The real question isn't whether dividends are right or wrong, it's whether your current extraction method aligns with where you want your personal wealth to be in 10 or 20 years' time. Some directors respond by leaving profits inside the company instead. They can feel prudent, but capital sitting in low-yield environments for extended periods could be quietly eroded by inflation and opportunity cost. So this isn't a debate about dividends versus no dividends. It's about location of capital. Where should profits sit? How should they move from the company balance sheet to personal wealth? And how does that decision interact with pensions, timing, and eventually an exit? And this is where wealth architecture begins to matter. So let's put this in a strategic context, because one area directors often review is employer pension contributions. Under current legislation, employer contributions are generally deductible for corporation tax. They move capital into a tax-advantaged structure, but annual allowance limits apply. Now, this isn't advice, this is simply how the tax framework currently operates. The strategic question becomes, how should extraction today support long-term flexibility tomorrow? Well, understanding the true cost of dividends is a foundation piece. In the next video, I'll explain how employer pension contributions work in practice, including the £60,000 annual allowance and where it fits within a broader extraction strategy. This is part of a wider series looking at how directors move money from company to personal wealth more intelligently. If that kind of structured, director-focused planning is useful, you may want to subscribe. I'm Stephen Pitcher, and I'll see you in the next video.